The rise of India's banking giant. What makes HDFC Bank the undisputed leader in India's banking sector? How did it rise from a newly formed private bank to becoming one of the most trusted financial institutions in the country? Today, we uncover the incredible journey of HDFC Bank, from its formation to its business model, revenue sources, challenges, and future prospects. Stay with us till the end for a deep dive into the numbers and strategies behind this banking powerhouse. Chapter 1. The birth of HDFC Bank. To understand the rise of HDFC Bank, we need to travel back to the early 1990s, a time when India was undergoing a monumental shift. The economy was opening up, foreign investments were encouraged, and private enterprises were given a new opportunity to thrive. But despite this transformation, the banking sector remained largely in the hands of public sector banks, known for long queues, tedious paperwork, and slow processing times. The Reserve Bank of India, RBI, recognizing the need for modernization and competition, introduced reforms that allowed private sector banks to enter the industry. This marked the beginning of a new era in Indian banking. Amidst these changes, Housing Development Finance Corporation, commonly known as HDFC, saw an opportunity. HDFC was already a trusted name in India's financial sector, primarily known for providing housing loans. But in 1994, the company decided to take a bold step, entering the banking industry and establishing HDFC Bank with approval from the Reserve Bank of India. At the heart of HDFC Bank's journey was a man with a clear vision, Aditya Puri. With an extensive background in banking, including years of experience at Citibank, Puri understood that the future of banking lay in efficiency, customer-centric services, and technological innovation. When he joined as HDFC Bank's first managing director, he set out to create a bank that was not just another financial institution, but one that redefined banking in India. He believed in a seamless banking experience, one that minimized paperwork, introduced digital solutions, and ensured that customers spent less time in queues and more time enjoying quality financial services. The journey wasn't easy. Competing against decades-old public sector banks was a challenge. But HDFC Bank had a strategy, focusing on retail banking, corporate banking, and a strong digital foundation right from the beginning. Little did India know that this small private bank, launched in 1994, would go on to become one of the most powerful financial institutions in the country. But how did it rise to the top? What strategies did HDFC Bank use to outshine its competitors? Let's find out in the next chapter. Chapter 2. The Growth Story. How HDFC Bank became a giant. HDFC Bank was not just another private bank. It was a revolution in Indian banking. Unlike traditional banks that took decades to establish their dominance, HDFC Bank moved aggressively from day one. With a sharp focus on technology, efficiency, and customer service, it quickly earned the trust of millions. By the early 2000s, HDFC Bank had already positioned itself as a leader in the private banking sector. But what were the key factors that fueled this rapid growth? Let's take a closer look. While most banks at the time focused primarily on large corporate clients, HDFC Bank took a different route. It aggressively expanded into retail banking. This meant providing financial services directly to individual customers, from savings accounts and loans to credit cards and personal banking solutions. By making banking more accessible to the common man, HDFC Bank tapped into a massive market. Whether it was home loans, car loans, or easy-to-use savings accounts, the bank ensured that every customer had a smooth banking experience. In the early 2000s, Digital banking was still a new concept in India. Many banks were slow to adapt to the internet revolution, but HDFC Bank saw the future early. It became one of the first banks in India to launch internet banking, giving customers the ability to access their accounts from anywhere. Not stopping there, HDFC Bank later introduced mobile banking, bringing banking services to people's fingertips. This move made it easier for customers to check balances, transfer money, and even apply for loans, all from their smartphones. One of the biggest turning points in HDFC Bank's journey was the acquisition of Times Bank in 2000. This was the first ever merger of two private sector banks in India, marking a historic moment for the industry. This merger not only increased HDFC Bank's customer base, but also strengthened its position in the private banking sector. With more branches, a wider network, and enhanced financial capabilities, HDFC Bank was now on its way to becoming an industry leader. As HDFC Bank expanded its services, its financial strength grew significantly. Investors took notice, and the bank stock became one of the most valuable in India's financial sector. From its IPO launch to becoming one of the most valuable companies on the stock exchange, HDFC Bank's journey is a masterclass in growth and strategic expansion. HDFC Bank's journey from a new private bank in 1994 to a financial giant in the 2000s is a story of vision, strategy, and execution. By focusing on retail banking, digital transformation, and smart acquisitions, it outperformed competitors and became one of India's most trusted financial institutions. But the story doesn't end here. How did HDFC Bank continue its dominance in the 2010s and beyond? What challenges did it face, and how did it overcome them? Stay tuned for the next chapter. Chapter 3. Business Model. How does HDFC Bank make money? HDFC Bank is one of India's most successful private banks. But have you ever wondered, how does it actually make money? Unlike traditional businesses that rely on selling products, banks generate revenue through multiple financial streams. HDFC Bank earns money from three main sources: net interest income, fee-based income, and treasury income. Let's break these down one by one. 1. Net interest income, NII, the core of banking revenue, 50 to 60%. The biggest chunk of HDFC Bank's revenue, nearly 50-60%, comes from what we call net interest income, NII. But what does this mean? Essentially, banks earn money by borrowing at a lower rate and lending at a higher rate. HDFC Bank collects deposits from customers and pays them a small interest, say 3 to 4% per year. But when it lends money to individuals and businesses, it charges a much higher interest, typically 8 to 15% per year. The difference between these two rates is called the net interest margin, NIM, and this is where the bank makes a majority of its money. Now, let's break down where this loan income actually comes from. HDFC Bank focuses on two major types of lending: retail loans and corporate loans. Retail loans, the largest contributor. A major part of HDFC Bank's loan book is retail loans, which means loans given to individuals. This includes home loans. Customers borrow money to buy houses, and HDFC Bank earns interest on these loans. Auto loans, financing for cars, bikes, and commercial vehicles. Personal loans, short-term loans for expenses like education, medical emergencies, or travel. Credit cards, when customers use credit cards, the bank earns from both interest on outstanding balances and transaction fees. Corporate loans, lending to businesses. While retail loans are a big focus, HDFC Bank also lends to corporations and businesses. These loans help companies expand, buy equipment, or manage cash flow. The bank earns interest on these loans just like it does with personal loans, but on a much larger scale. 2. Fee-based income, 25 to 30%, the extra boost. While interest income is the primary source of revenue, HDFC Bank also makes 25 to 30% of its money from fee-based services. That is, services where customers pay fees without taking a loan. Key sources of fee-based income. 1. Credit card fees, annual fees, late payment fees, and interest on unpaid balances. 2. Loan processing fees, charges when customers apply for home loans, car loans, or business loans. 3. Account maintenance fees, minimum balance charges, overdraft fees, and service charges for accounts. 4. Investment banking and wealth management, fees for managing large-scale financial deals and investment portfolios for high-net-worth individuals. 3. Treasury income, 10 to 15%, smart investing. The third revenue stream for HDFC Bank comes from treasury operations, which contributes 10 to 15% of the bank's income. But what does this mean? How does treasury income work? 1. Government bonds and securities. HDFC Bank invests in government bonds, earning interest over time. 2. Foreign exchange transactions, profiting from currency exchange services and international trade financing. 3. Stock market and corporate investments, buying and selling financial instruments for profit. So, to summarize, HDFC Bank's business model is well diversified, generating revenue from multiple sources. 50 to 60% from net interest income, loans and deposits. 25 to 30% from fee-based income, credit cards, service fees. 10 to 15% from treasury income, investments and trading. This multi-channel revenue approach ensures that HDFC Bank remains profitable even if one segment faces challenges. Whether it's loan interest, service fees, or smart investments, HDFC Bank has built a financial powerhouse that continues to dominate the banking industry. Chapter 4. Competitive Edge. What sets HDFC Bank apart? In a country with over 30 major banks, what makes HDFC Bank stand out as the leader in private sector banking? While many banks struggle with bad loans and inconsistent performance, HDFC Bank has built a reputation for stability, profitability, and innovation. But how? 1. Consistent profitability, the bank that keeps winning. One of the biggest strengths of HDFC Bank is its consistent profitability. Unlike many other banks that struggle with bad loans, HDFC Bank has managed to keep its non-performing assets, NPAs, among the lowest in the industry. Non-performing assets, or NPAs, refer to loans that borrowers fail to repay. A high NPA means a bank is losing money due to bad loans. But HDFC Bank has strict risk management, ensuring that only creditworthy customers get loans, reducing its bad loan percentage. HDFC Bank, 1%. ICICI Bank, 3%. SBI, 4%. Axis Bank, 2.5%, asterisk. By keeping NPAs low, HDFC Bank ensures steady profits, making it a preferred choice for investors and customers alike. 2. Customer-centric approach, banking with a personal touch. While many banks focus purely on growth, HDFC Bank has always prioritized customer experience. From quick loan approvals to superior customer service, it ensures a seamless banking journey. HDFC Bank, 4.5/5. ICICI Bank, 4.2/5. Axis Bank, 4.0/5. SBI, 3.5/5. With features like 24/7 customer support, doorstep banking, and faster loan approvals, HDFC Bank makes banking easier for millions of customers. This is a key reason why it has one of the highest customer retention rates in the industry. 3. Technology and digital banking. The future of banking. In today's digital world, banking is no longer about visiting branches. It's about convenience at your fingertips. HDFC Bank has been a leader in digital banking, offering internet and mobile banking, seamless online transactions, fund transfers, and bill payments, UPI and digital payments, strong integration with UPI, making instant payments easier, AI and chatbots, automated customer service through AI-powered chatbots, robo-advisors, AI-driven investment recommendations for customers. Compared to public sector banks, which still rely on traditional methods, HDFC Bank has aggressively adopted technology, making banking more efficient and user-friendly. 4. Strong management. Leadership that drives success. A bank's success is driven by its leadership, and HDFC Bank has had some of the most visionary leaders in the banking industry. Under Aditya Puri's leadership, HDFC Bank grew from a small private bank in 1994 to India's largest private sector bank by 2020. His focus on customer service, risk management, and innovation laid the foundation for HDFC's dominance. In 2020, Sashidhar Jagdishan took over as CEO, continuing the legacy of growth and innovation. His focus on digital banking, customer experience, and financial inclusion ensures that HDFC Bank remains the market leader. So what makes HDFC Bank stand out? It's not just about being the biggest private bank. It's about being the best. With consistent profitability, a strong customer focus, advanced digital banking, and exceptional leadership, HDFC Bank continues to set the benchmark in Indian banking. Chapter 5. Challenges and risks for HDFC Bank. HDFC Bank is India's largest private sector bank, known for its innovation, profitability, and strong customer base. But even the biggest banks face challenges. So what risks does HDFC Bank face? 1. Regulatory pressure. The RBI's tightening grip. Banking is a highly regulated industry, and the Reserve Bank of India, RBI, plays a crucial role in monitoring banks. Over the years, HDFC Bank has faced increasing scrutiny from the RBI, leading to restrictions and penalties. In 2020, the RBI imposed restrictions on HDFC Bank's credit card issuance and new digital initiatives due to repeated technology failures. While the issue was later resolved, it highlighted the risk of regulatory action affecting business growth. With the government tightening rules on digital banking, lending practices, and data security, banks like HDFC must constantly adapt to avoid penalties and maintain compliance. 2. Rising competition, the fintech disruption. A decade ago, banks dominated financial services. But today, fintech startups and NBFCs, non-banking financial companies, are challenging traditional banks with faster and more flexible services. Fintech companies like Paytm, PhonePe, and Google Pay have revolutionized payments, while NBFCs like Bajaj Finance offer quick and easy loans. Many customers now prefer these platforms over traditional banking. UPI transactions in India crossed 15 Indian rupees lakh crore in 2024, with platforms like Google Pay and PhonePe processing most of these transactions. This reduces the need for traditional banking services and puts pressure on banks to innovate. Merger challenges, the HDFC Bank integration. In 2023, HDFC Bank and HDFC Ltd announced India's biggest banking merger, creating a financial powerhouse. But with any large merger comes major challenges. Key merger challenges. Integration of operations. Merging two large institutions requires aligning thousands of employees, systems, and processes. Regulatory compliance. The RBI and SEBI have strict guidelines for mergers, which can delay operations. Customer experience. A sudden transition can lead to service disruptions, causing frustration among customers. Even though the merger strengthens HDFC Bank's position, the short-term impact on operational efficiency and customer experience remains a major challenge. Despite these challenges, HDFC Bank remains one of the strongest players in the industry. With robust leadership, continuous technological advancements, and strong risk management, the bank is well-positioned to overcome these risks. However, it must continue to adapt, innovate, and maintain regulatory compliance to stay ahead of the competition. Chapter 6. Future of HDFC Bank. Can it maintain its dominance? HDFC Bank has grown from a small private bank in 1994 to India's largest private sector bank today. But in a rapidly evolving financial world, can it maintain its dominance? What is the future of HDFC Bank? 1. Expansion into rural banking, the untapped market. Despite India's rapid economic growth, a large part of the population remains unbanked or underbanked. HDFC Bank sees this as a massive opportunity to expand into rural banking. Bar chart statistics. Only 30 to 35% of India's rural population has access to formal banking. Over 65% of India's population still resides in villages. HDFC Bank is launching initiatives to bring banking to remote areas, offering financial products tailored to farmers, small businesses, and rural households. Key rural banking strategies. More branches in small towns and villages, expanding beyond urban centers. Easy digital access, mobile banking apps in regional languages. Agri and MSME loans, supporting farmers and small business. With a stronger rural presence, HDFC Bank can tap into millions of new customers, ensuring long-term growth. 2. AI and digital transformation, the future of banking. Banking is no longer just about branches and ATMs. The future belongs to AI-driven banking, automation, and seamless digital experiences. HDFC Bank's AI-driven future. AI-powered customer service. Chatbots handling millions of queries in real time. Smart credit and loan approvals. AI assessing risk and approving loans instantly. Fraud detection and cybersecurity. AI monitoring suspicious activities. HDFC Bank has already integrated AI in its operations. Chatbots like Eva assist customers 24/7, while machine learning models help detect fraud faster than ever. Future projection. By 2030, over 80% of banking transactions will be handled by AI and automation. Mobile and digital banking will overtake physical branches. 3. Global aspirations. Can HDFC Bank go beyond India? India's banking sector is growing rapidly, but can HDFC Bank expand its dominance beyond India? HDFC Bank's global strategy. NRI and international banking services, catering to Indians living abroad. Foreign business investments, partnering with global firms. Expanding presence in emerging markets, targeting Southeast Asia, Africa, and the Middle East. While HDFC Bank is not a global player yet, strategic expansions in foreign markets could make it a major international banking force in the next decade. The future of HDFC Bank looks promising, but it must continue to innovate, expand, and adapt to maintain its dominance. Only time will tell if it can truly become a global banking giant. Conclusion and investment perspective. Is HDFC Bank still a good investment? HDFC Bank has been one of India's most successful banking institutions, delivering consistent growth over the years. But with evolving market trends, regulatory changes, and rising competition from fintech companies, one big question remains. Is HDFC Bank still a good investment? 1. Strong fundamentals, the backbone of HDFC Bank's growth. HDFC Bank's key strengths: consistent profitability, one of the highest profit-making banks in India. Low non-performing assets, NPAs. Strong risk management ensures fewer bad loans. Market leadership, the largest private sector bank with a growing customer base. HDFC Bank has built a solid reputation for stability and growth. It consistently delivers strong financial results and has one of the lowest NPAs, non-performing assets, in the banking sector. 2. Key risks, what investors should watch out for. Regulatory risks. The Reserve Bank of India, RBI, has imposed restrictions on private banks in the past. Regulatory oversight may limit aggressive expansion plans. The banking industry is changing. While HDFC Bank has been a leader in innovation, competition from fintech startups and regulatory hurdles could slow down its aggressive growth. 3. Post-merger future. A game changer? The merger effect. HDFC Ltd merged with HDFC Bank in 2023, creating a banking giant with a stronger home loan portfolio. The merger brings access to new customers and higher cross-selling opportunities. Post-merger growth projections. Loan book growth is expected to rise by 20 to 25% annually. The HDFC Bank merger has created India's largest financial institution, boosting growth potential. But integration challenges and operational efficiency will determine how successful this merger truly is. 4. Final verdict, should you invest? Investment perspective. Long-term potential. Strong fundamentals make HDFC Bank a stable choice. Market leader. It remains India's most valuable private sector bank. Merger benefits. The combined entity has a bigger loan portfolio and better growth opportunities. So, is HDFC Bank still a good investment? The answer depends on your investment horizon. If you're a long-term investor, HDFC Bank remains a strong bet due to its leadership position, financial strength, and post-merger growth potential. However, short-term investors should be cautious of market trends, fintech disruptions, and regulatory risks. HDFC Bank has dominated the banking industry for decades, and it is still in a strong position. But as the financial world evolves, staying ahead will require continuous innovation and adaptation. What do you think? Will HDFC Bank continue its dominance, or will fintech disrupt its future? Let us know in the comments. After learning about HDFC Bank in detail, if you decide to invest in the company, you'll need a demat account to purchase its shares. If you don't have one, you can open an account with India's trusted broker by clicking the link in the description.